Have you ever looked at a company, maybe one just starting out or, even a big established one and thought, okay, how did they get all that funding?
Right. It seems simple on the surface. Company needs money, company raises money.
Yeah, but behind that, there's this incredibly complex, sometimes really high stakes journey. And that's the real story, isn't it?
It absolutely is. Far more than just picking up the phone. What we're diving into today is what finance folks call the new issue process. It's all about capital formation.
Capital formation.
Yeah. It's the fundamental way companies, whether they're brand new or giants of industry, get the cash they need. We're talking serious capital to grow, to innovate, sometimes just to keep the lights on. And they do it mostly by selling stocks or bonds.
So our mission today for you listening is to really pull back the curtain on this. We want to untangle the whole thing, underwriting, regulations, the different ways securities actually hit the market.
Exactly. Think of it as your shortcut to getting properly informed about a really core part of finance. We'll dig into some surprising facts and really get to the why behind how it all works.
We'll cover the main routes, public versus private offerings. We'll look at the absolutely critical role of underwriters, investment bankers.
Yep, and the different kinds of risks they take on, those commitments. And then we'll walk through the whole regulatory maze, required by laws like the big one, the Securities Act of 1933.
By the end, hopefully you'll see how all these different pieces connect, get the whole picture.
That's the plan.
Okay, let's jump in. First stop, the gateway to growth, understanding capital formation. So basically, it's how a corporation or, well, any issuer really, sells stocks or bonds in a formal offering to raise money.
That's the heart of it. It's truly the lifeblood for expansion. Without it,
Right.
well, startups couldn't scale up, big companies couldn't launch new things.
Even governments rely on it, right?
Right, absolutely. For funding services. But, the actual process, the rules, they can vary a lot. Depends on who's issuing and who they're selling to.
How so?
Well, a regular corporation issuing stock, they're under pretty strict federal SEC rules. But, say, the U.S. Treasury issuing bonds, they're actually exempt from a lot of that SEC registration stuff. It's a whole spectrum.
Interesting. Okay, so you mentioned different routes. The two main ones are public offerings and private placements.
That's right, public offerings. The name kind of gives it away. The huge advantage. You can sell to an unlimited number of investors, anyone really. Retail folks like you, huge institutions, everyone's invited.
Sounds great. Broad reach?
It is, but
Yeah.
there's always a but, isn't there? It comes with a big price tag.
The costs.
Yeah. Significant legal fees, accounting costs, plus just the sheer time it takes to prepare all the paperwork, meet all the disclosure rules under the Securities Act of 1933. It's a major undertaking.
Okay, so that leads us to the other path, private placements.
Exactly. These are non-public, often used by newer companies, maybe seeking that initial seed or startup capital. Instead of going wide, they go directly to specific, usually large institutional investors.
Like who?
Think pension funds, insurance companies, venture capital firms, private equity, the big players.
Sounds much more targeted.
It is. And the big advantages there are speed and cost. Much faster to complete, way less expensive than going public.
But the catch?
The catch is you're limited. There's strict rules on the type of investors and, crucially, the number of investors who can participate. You can't just sell it to anybody.
Makes sense. So ideal for that strategic, maybe faster funding round.
Precisely.
Okay, let's clear up some terms people hear all the time. IPO versus follow-on offering. IPO, initial public offering. That's the famous one, right?
That's the big debut. It's the very first time a company offers its securities, like stock, to the general public. It's often seen as a huge milestone for a company.
Coming of age, almost. And a follow-on.
That's when a company is already public. Its stock is trading, but it decides it needs to raise more money by selling additional shares of common stock.
Okay, so IPO is the first time, follow-on is later, but you said both are primary distributions. What does that mean for, say, the company or an investor?
Good question. The key takeaway for primary is simple. Who gets the money? In a primary distribution, whether it's an IPO or a follow-on, the proceeds from selling those shares go directly to the company.
Okay. So the company is issuing new shares and the cash comes into their bank account.
Exactly. It increases the total number of shares out there, and the company uses that cash for growth, operations, whatever they need.
Which brings us to another really important distinction, primary versus secondary distribution. This is the who gets the money question again, right?
Absolutely critical distinction. We just said primary means the issuer gets the funds.
Right.
In a secondary offering, it's different. Here, you have existing shares being sold by current shareholders. Think company founders, early investors like VCs, maybe executives. They're selling some of their own stock.
So they're cashing out, basically.
Often, yes, or diversifying. But the crucial point is the money from that sale goes directly to those selling shareholders. It does not go into the company's coffers.
That's a huge difference. The company gets no direct financial benefit from a secondary offering.
Correct, which is why it's vital for investors to know which type of offering it is. And sometimes you see combined or split offerings.
A mix of both.
Yeah, the company sells some new shares, primary, and some existing shareholders sell their shares, secondary, all at the same time.
Okay, that seems like it could be confusing.
It could be, which is why underwriters have a strict obligation to tell purchasers very clearly that part of the money is going to selling shareholders, not just the company. A FINRA actually has a specific rule, Rule 2269, demanding written disclosure on this. Transparency is key.
Makes sense. Gotta know where the money flows. Okay, so we know how companies sell and who gets paid. Let's talk about the underwriter or the investment banker. They're more than just a go-between.
Oh, much more. An underwriter is typically a broker-dealer, and their main job is helping corporations or even municipalities raise that capital we've been talking about.
How do they do that?
Well, yes, they connect the issuer with potential buyers,
Yeah.
but they also do market analysis, advise on structuring the deal, help set the price, and often, and this is key, they take on significant financial risk.
Risk? Huh?
Sometimes they actually agree to buy the entire batch of new securities from the company themselves, and then it's their job to resell it to the public. The money they help raise can be fresh capital for the issuer, or maybe it's used to refinance debt. They're really strategic partners.
Okay, buying the whole issue. That sounds risky, which leads nicely into the different underwriting commitments. This tells you how much risk they're actually taking on.
Exactly. It defines their level of liability. The first big type is a firm commitment underwriting.
Firm commitment. Sounds serious.
It is. Here, the underwriting syndicate, that's the group of broker-dealers managing the deal, agrees upfront to buy the entire offering from the issuer, period.
The whole thing, even if they can't sell it all.
Yep, they're at risk. They're acting as principal, essentially owning the securities. So if a company wants to sell, say, $10 million worth of stock, and the syndicate manages to sell only $8 million to investors.
They're stuck with the leftover $2 million.
They are. They have to buy it for their own accounts. The huge plus for the issuing company, certainty. They know they're getting their $10 million no matter what the public appetite is.
Wow. Okay, that's a big risk for the underwriters. What's the alternative? Less risk.
The other main type is a best efforts commitment. Here, the syndicate acts more like an agent, not a principal.
Agent meaning?
Meaning they simply promise to use their best efforts to sell as much as possible of the offering. They don't guarantee they'll sell it all.
So if they only sell $8 million of that $10 million offering,
then only $8 million worth of stock gets issued. The unsold $2 million worth. It effectively gets returned to the issuer. It just never gets sold. The syndicate doesn't buy the unsold portion.
so the risk of the offering not selling well stays with the company in that case.
Exactly. Less risk for the underwriters, but less certainty for the issuer.
But what if the company absolutely needs a minimum amount of money for the whole project to even make sense? Like, they need $7 million for a factory, or the whole $10 million offering is pointless.
Ah, good point. That's where you get best efforts contingencies. Because sometimes, yeah, minimums really matter.
What kind of contingencies?
Well, one common one is called all or none, AON.
All or nothing. Sounds dramatic.
It is. In an AON deal, if the underwriters cannot sell the entire offering down to the last share, then the whole deal is canceled. Any sales already made are voided, and any money collected from buyers has to be returned.
Wow. So the company gets exactly the amount they needed or absolutely nothing.
Correct. Ensures they hit their target or they don't proceed at all.
Okay. Any other variations?
There's also the mini-maxi.
Mini-maxi.
Yeah. Here, there's a minimum sales goal that must be hit for the offering to proceed. If they don't sell the minimum, it's canceled like an AON. But if they do hit the minimum, the offering becomes effective, and they can continue selling shares up to a predetermined maximum amount.
Ah, okay. So using that $10 million example, maybe they need at least $7 million, the mini.
All right.
If they sell $7 million, the deal is on.
Right. And then they can keep selling, trying to reach the full $10 million, the maxi, without the risk of the whole thing collapsing if they only get, say, $9 million sold. Gives the issuer a bit more flexibility than AON.
Got it. That makes sense. Are there other sort of specialized agreements?
Yeah, a couple worth mentioning. One is a standby agreement. You usually see this with preemptive rights offerings.
Rights offerings. That's when existing shareholders get first dibs on new shares, often at a discount.
Exactly. But what if not all shareholders exercise their rights? The company might end up short on the capital they expected, so they might arrange a standby underwriting. The syndicate agrees, usually on a firm commitment basis, to stand by and purchase any shares that the existing shareholders don't subscribe to. They guarantee the full amount gets raised one way or another.
Okay, so they backstop the offering. What about a market out clause? That sounds like an escape hatch for the underwriters.
It kind of is. It's a crucial protection for them, actually. If an underwriting agreement has this clause, it allows the syndicate to back out of the deal if certain major negative events happen that make selling the issue incredibly difficult or maybe even impossible.
Like what kind of events?
Could be something specific to the company, a sudden huge lawsuit, a factory burns down, a material adverse event. Or it could be broader, a major stock market crash, a sudden geopolitical crisis, basically a massive disruption that fundamentally changes the market conditions. It protects them from truly unforeseeable disasters.
Right, protects them from situations way outside their control. Okay, one more underwriting mechanism, shelf registration. What's the idea there?
Shelf registration is pretty clever. It's mainly for larger, already public companies. It lets them do most of the complex SEC registration paperwork in advance for securities they plan to issue over the next few years.
So they file everything up front.
Right. They register an amount they reasonably expect to sell within 3 years. Then, those registered securities sit on the shelf, ready to go. When market conditions look perfect, or they suddenly need capital quickly.
They can just pull them off the shelf and sell them without going through the whole registration process again.
Exactly. Minimal delay. It gives them huge flexibility to time the market and react quickly to opportunities or needs.
That sounds really efficient for big, active companies. Do the paperwork once, sell multiple times.
Precisely. It's a powerful tool.
Okay, let's shift gears slightly. Let's talk about the network, the pricing, how people get paid, and the vital due diligence. We mentioned the underwriting syndicate earlier. Can you break that down a bit more?
Sure. The syndicate is that core group of broker-dealers, the investment banks, that band together to manage the offering. Leading the charge is the syndicate manager, sometimes called the lead underwriter or book runner.
And they do. What exactly?
A lot. They conduct really deep due diligence on the company, checking financials, management, legal stuff, comparing it to similar companies. They're the ones who actually assemble the rest of the syndicate members. They play a huge role in pricing the deal, marketing it, building the book of orders from investors, and sometimes even stabilizing the stock price right after it starts trading.
And the agreement that binds them all together.
That's formally called the agreement among underwriters, sometimes just the syndicate letter. It spells out everyone's responsibilities, liabilities, how many shares each member is handling, etc.
Okay. Then there's the selling group. How do they fit in? Are they part of the syndicate?
No, they're distinct. The syndicate manager might bring in additional broker-dealers to help sell the shares. That's the selling group. They widen the distribution network.
But what's the key difference?
Liability. Selling group members do not take on financial risk for the offering. They act purely as sales agents. If they don't sell their allotment of shares, those unsold shares go back to the syndicate members who are financially responsible.
Ah, okay. So the syndicate holds the risk. The selling group just helps sell. They probably have their own agreement too.
Yep, a selling group agreement outlining their role and compensation. And, collectively, all these firms involve the syndicate members, and the selling group are often just called the distribution participants.
Got it. Division of labor and risk. Now, pricing. How do they actually set the public offering price, the POP? Especially for an IPO where there's no existing market price.
That's definitely more art than science sometimes. For an IPO, it's a fixed price. The underwriters look at a whole range of factors. The company's earnings history and potential dividend policy, the valuation of similar public companies, how much interest they got during the testing the waters phase.
The indications of interest.
Exactly. And, of course, the general mood and conditions of the overall stock market at that moment. They try to find that sweet spot high enough for the issuer, but attractive enough for investors.
What about for a follow-on offering where the stock's already trading? Is it just the market price?
Usually it's set at a slight discount to the current market price. Just a small incentive to encourage investors to buy the new shares being offered.
Makes sense. So how do all these firms actually make money doing this, the underwriting spread?
Right, the spread. It's simply the difference between what the public pays per share, the POP, and what the issuing company actually receives per share. That gap is the gross profit for the entire distribution group.
And how is that spread divided up?
It typically has a few components. There's the manager's fee, which goes to the lead underwriter for managing the whole process.
Okay.
Then there's the member's fee or underwriter's fee. This is also called the additional takedown. It compensates the syndicate members for taking on the actual financial risk, the liability.
Right, for being on the hook.
And finally, there's the concession or selling concession. This piece goes to the specific firm, whether it's a syndicate member or a selling group member, that actually sells the share to the end investor.
So if a syndicate member sells a share themselves, they get both the underwriter's fee for risk and the concession for selling.
Exactly. And that combination, underwriter's fee plus concession, is called the total takedown. That's what a syndicate member earns on shares they sell directly.
And the selling group members, since they don't take risk.
They only earn the selling concession for the shares they sell. No risk fee for them. Clear division of reward based on risk and effort.
Okay, that structure makes sense. Now here's a tricky area you mentioned earlier. Payments for market making. This sounds like a potential minefield.
It is, and FINRA keeps a very close eye on it. The concern is about conflicts of interest. Imagine a broker-dealer helps underwrite an IPO,
Okay.
and then also acts as a market maker for that same stock once it starts trading in the secondary market.
Right. Providing liquidity, quoting prices.
Yeah. FINRA rules strictly prohibit that firm from accepting any payment from the issuer or its affiliates specifically for making a market, publishing quotes, or even just applying to be a market maker.
Why is that prohibited?
To prevent manipulation, essentially. You don't want issuers secretly paying market makers to artificially prop up the stock price or create misleading activity. It undermines market integrity.
So no side payments for market making, but they can get paid for the underwriting itself.
Oh, absolutely. They can receive legitimate payments for bona fide services like the underwriting spread we just discussed, and they can be reimbursed for things like SEC registration fees or exchange listing fees. But there's a very firm line against payments designed to influence their secondary market activity. It's all about keeping those roles separate and transparent.
That seems crucial for fair markets. Okay, this naturally leads us to the bedrock regulation governing all of this, the Securities Act of 1933. What was the main goal behind this landmark act?
It came about after the 1929 crash, really. Its core purpose is twofold. First, prevent fraud in the sale of new securities issues. And second, ensure investors get enough accurate and complete information to make informed decisions before they buy.
Information is key. And how does it ensure that?
Primarily through the mandatory filing of a registration statement with the SEC. And the process of getting that registration approved happens in three distinct phases.
Okay, phase one.
Phase one is the pre-registration period, also called the pre-filing period. This is when the issuer, usually working closely with their underwriter, puts together that massive registration document.
And what can't they do during this time?
Critically, the underwriter absolutely cannot discuss the upcoming issue with potential customers yet. No marketing, no hyping. It's a quiet period for sales talk. But behind the scenes, the lead underwriter is starting their intense due diligence.
Digging into the company's details.
Deeply. This phase ends the moment they officially file that registration statement with the SEC.
And what's in that statement? You said it was massive.
It is incredibly detailed. You'll find info on the issuer's business model, its management team, its ownership structure, detailed financial statements, balance sheet within 90 days, a couple years of P&L, how they plan to use the money raised, any payments going to insiders, who the major shareholders are, pretty much everything.
A complete picture, ideally. And the prospectus is basically the investor-facing version of this.
That's right. It's an abbreviated form designed for potential buyers. And it carries that really important disclaimer. We should mention Section 23 of the 3 Act.
What does that say?
It states very clearly, usually right on the cover, that the SEC has not approved or disapproved the securities, nor has it passed judgment on the accuracy or adequacy of the prospectus. It's a warning. The SEC reviewed this for disclosure completeness, not whether it's a good investment.
So underwriters definitely can't say the SEC approved this deal.
Absolutely not. Strictly forbidden. It makes it clear that investors need to do their own thinking using the disclosed information.
Okay, phase one, preparation and filing. What's phase two?
Phase two is the cooling off period or waiting period. It traditionally lasts 20 days after filing.
Cooling off. What happens?
During this time, the SEC staff reviews the registration statement. Again, they're looking for completeness, clarity, any misleading statements. They are not judging the investment merits or the fairness of the price.
And if they find problems?
They issue a deficiency letter or letter of comment
Mm.
to the issuer, pointing out the issues. The issuer then has to fix them and usually file an amendment, which typically restarts the 20-day clock.
Okay, so while the SEC reviews, what can the underwriters do now? Can they talk about it yet?
Yes, now they can start talking. This is when they can test the waters. They can discuss the potential offering with institutional investors, sometimes retail investors. They could distribute their preliminary prospectus.
Ah, the red herring.
That's the one. Call that because of the bold red legend on the cover stating that the registration isn't effective yet and the information is subject to change. Crucially, it omits the final offering price, though it might include an estimated price range.
Then they can collect.
They can collect indications of interest. These are non-binding expressions from investors saying they might be interested in buying shares if and when the deal becomes effective. Think of it as building a potential order book.
But they cannot take money or confirm sales yet?
Absolutely not. No sales, no money changes hands during the cooling off period. The deal isn't final, it isn't priced.
And you mentioned earlier you can't mark up the red herring either. No highlighting.
Correct. The prospectus is a standardized disclosure document. It must be delivered without any underlining, highlighting, or summarizing by the broker. Everyone should get the same unaltered information straight from the document.
Okay. Federal review is happening. What about state laws during this time? The blue sky laws?
Yep, they run concurrently. Issuers generally have to register the offering in each state where they plan to sell securities. This is often done through methods laid out in the Uniform Securities Act. Three main ways: notification or filing, which is a simpler process for large, established issuers with a track record; coordination, where the state registration happens in sync with the SEC review and becomes effective at the same time; and quantification, which is used if the other methods aren't available and involves meeting specific requirements of that particular state, with effectiveness depending on the state administrator's review.
So federal and state compliance running in parallel. Busy time. And just before this period ends, there's a due diligence meeting.
Yes, typically held right before the expected effective date. It's a critical final check-in.
Who is there?
You'll have the key players, the lead underwriter, other syndicate members, senior officers from the issuing company, their lawyers, the accountants. Everyone involved gets together
Why? What's the goal?
to conduct a final review of the offering details, the underwriting procedures, and essentially certify that everything is accurate, complete, and compliant with all the relevant securities laws. It's a crucial step for liability protection. Everyone confirms they did their homework.
Final sign-off, basically. Okay. Which leads us to phase 3, the post-effective period. This starts with the effective date.
Exactly. The SEC declares the registration effective. This signals the end of the cooling-off period. While technically 20 days after filing the last amendment, the SEC can accelerate this upon request.
And now?
Now the fun begins. The underwriters finalize the public offering price, POP. Sales can officially commence.
And investors who buy must get the final prospectus.
Yes, they have to receive the final official prospectus, which now includes the POP and other final details, no later than when they receive their trade confirmation.
Right.
Nowadays, electronic delivery, providing access, usually satisfies this requirement.
Okay, but then there's this aftermarket prospectus delivery requirement. Why do dealers sometimes still need to provide a prospectus even after the initial sale is done?
This rule provides ongoing protection, especially for newly public companies where information might still be scarce. The idea is that even people buying the stock in the immediate aftermarket should have easy access to the official disclosure document.
How long does this requirement last? Does it vary?
It does vary, depending on the offering type and whether the stock is listed on an exchange. For an IPO of a company that will not be listed on NYSE or NASDAQ.
Like an OTC stock.
Right. Dealers trading that stock have to deliver a prospectus for 90 days after the effective date. If it's a follow-on offering for an unlisted company, it's 40 days.
Okay, longer periods for unlisted stocks make sense. Less public info floating around. What about stocks listed on major exchanges like NYSE or NASDAQ?
The periods are shorter. For an IPO that's listed on NYSE or NASDAQ, the requirement is 25 days. The reasoning is that listed companies get more analyst coverage and public scrutiny faster.
And for a follow-on offering of an already listed stock?
For those, there's actually no aftermarket prospectus delivery requirement. The market is assumed to be efficient, with plenty of continuous information already available through exchange filings, news, etc.
That logic follows. Okay, let's quickly recap the different types of prospectuses and communications someone might see. We have the main one, the statutory prospectus.
Right, that's the final official document derived from the registration statement. Contains all the key info, risk factors, use of proceeds, financials, management, etc.
Then the tombstone ad.
That's just a simple, factual announcement ad. Identifies the security, price, underwriters, and tells you where to get a real prospectus. It's very limited in scope, so it's not considered an offering document itself.
We talked about the preliminary prospectus or red herring used during cooling off.
Yep, the one missing the final price.
Then for mutual funds, there's a summary prospectus.
Yeah, a much shorter, user-friendly version, maybe 3 to 4 pages. It hits the highlights, objectives, costs, risks, performance, manager info, and tells you how to get the full statutory prospectus, designed to make fund comparison easier.
Okay. And lastly, free writing prospectuses or FWPs. What are those?
An FWP is basically any written communication that offers the security or solicits interest, but doesn't meet the formal requirements of a statutory prospectus. Think press releases, emails, web pages, marketing materials, even video roadshows.
So more flexible communication.
More flexible, yes, but not unregulated. They're called free writing because they're freer in format than the statutory prospectus, but they generally still need to be filed with the SEC once the registration statement is filed. They can't be misleading.
Got it. And just to round it out, for private placements where there's no SEC registration, they use an offering memorandum.
Correct. Often called a private placement memorandum, or PPM. It's the disclosure document for those non-public offerings. Contains similar types of information as a prospectus, but tailored for sophisticated institutional buyers and doesn't go through the SEC review gauntlet.
Wow. Okay. That was quite a journey. We went from just the basic idea of a company needing money all the way through this incredibly detailed, multi-stage, highly regulated process to actually bring a new stock or bond to the market.
It really highlights how many players are involved. The issuer, the underwriters, the syndicate, the selling group, lawyers, accountants, regulators, all playing critical roles.
And the whole structure seems designed to manage risk, ensure information flows, and ultimately get that capital where it needs to go to fuel business and the economy.
Absolutely. It's complex, for sure, but there's a logic to it, built over decades, largely focused on investor protection and market integrity. All those checks and balances, the due diligence, it's meant to build confidence.
So maybe the next time you, listening, hear about a big IPO hitting the market or just a company announcing a new funding round, you'll have a few new questions in mind.
Right. Like, how much risk did the underwriters take? Was it firm commitment or best efforts? Is it a primary offering, funding the company, or secondary, with insiders cashing out?
Yeah. How does understanding that whole intricate dance, the commitments, the regulations, the prospectuses, the due diligence, change how you think about capital flowing through our economy? It's not just magic money appearing. There's this whole hidden layer making it possible.
Definitely gives you a new appreciation for what goes on behind the headlines.